Welcome to our analysis. This is Taozui Shalong. A 30-minute fulfillment window changes the floor plan. For the picker, foot traffic and aesthetic displays are hindrances. Speed requires a space designed for a continuous loop of selection and packing. The March 2026 report by QinCe Consumer Research, titled 2026 In-Depth Analysis of China's Lightning Store Model, provides the data for this analysis. Our examination includes figures up to late 2025. The dark store network has expanded from 3,000 locations in 2021 to over 50,000 in 2025. By 2027, the projection reaches 100,000 nodes, representing 200 billion RMB in annual volume. This volume reflects a shift in consumer behavior, as delivery speeds allow these stores to compete for the daily transactions previously handled by brick-and-mortar convenience chains. Part 1 of our analysis tracks the specific category shifts and the model's capture of high-margin night spending. Part 2 examines the unit economics, focusing on the consolidation forcing single-store franchisees out of the market. Part 3 maps the geographic pivot away from saturated coastal hubs into the country's interior. To truly understand the next decade of Chinese retail, we must deconstruct the mechanics of this high-fulfillment engine. The Lightning Store, or platform-based dark store, has zero front-facing retail space. It operates exclusively online, often utilizing low-rent warehouses or basements. By removing customer aisles, operators can fit 5,000 to 10,000 distinct products into a 200 square meter footprint, roughly 1.5 times the capacity of a standard convenience store. This inventory density allows the service to move beyond its original emergency focus. Consumers who once used 30-minute delivery for fever medication are now using it for groceries, beauty products, and even specialized gear like camping equipment. For younger consumers in the 90s and 2000s, this speed creates a baseline expectation of immediate availability rather than planned shopping. Large-scale platform subsidies, totaling nearly 200 billion RMB in 2025, were instrumental in training this consumer habit. Operating without retail hours allows these stores to capture the night economy, a segment traditional brick-and-mortar stores often struggle to serve profitably. General order data shows that between 15 and 20% of transactions occurred during night hours. In specific categories, reliance on off-hours fulfillment is even higher. 40% of liquor and 60% of adult product sales happen during this night segment. By operating 24/7 in a low-overhead environment, the dark store model absorbs the high-margin spending that traditional convenience stores miss after midnight. The macro landscape for these platforms follows an oligopoly structure, with 3 major players controlling the majority of the market. Meituan currently dominates the ecosystem with a 70% share. Taobao holds 25%, while JD focuses on a targeted share of under 5%, largely in electronics. However, platform dominance does not guarantee the stability of the individual franchisee holding the lease and the inventory. Currently, only 40% of single-store operators are turning a profit. The difference between survival and closure comes down to specific volume metrics. Profitable units maintain over 400 daily orders at a 45 RMB average ticket. Failing stores struggle below 200 orders at a lower price point. A 20% margin allows for a payback period of 12 to 18 months. At an 18% margin, the lack of volume pushes the payback period past 3 years. With platform fees and delivery costs consuming 15 to 20% of revenue, independent operators with slow inventory turnover are often squeezed out. Scale is the primary mechanism for survival. The industry is consolidating rapidly. Of the dozens of brands that initially entered the space, only 3 have maintained a top-tier performance position for 3 consecutive years. These survivors are Meituan, Xiaoqigo, and Baihui. Their strength lies in procurement. By bypassing regional wholesale markets and negotiating direct contracts with brands, they lower their supply costs by 5 to 10%. This leverage has allowed Meituan to scale to over 3,200 locations across the country. Similarly, Xiaoqigo dominates the Southwest with over 750 stores, supported by a 20,000 square meter central distribution hub. These brands also rely on digital precision. Managing thousands of items in 30-minute increments is impossible without automated systems. They utilize proprietary ERPs, integrated with systems like Meituan's Qianyuhua, to maintain 99% inventory accuracy across 8,000 items, automating replenishment before stockouts occur. In this environment, profitability depends on upstream leverage and inventory precision, rather than the traditional advantage of a high-traffic street corner. The geography of the dark store model is entering a new phase. In Tier 1 coastal cities, the market is approaching saturation. With cities like Beijing and Shanghai hosting over 3,000 dark stores each, growth has transitioned from new expansion to zero-sum optimization of existing sites. New expansion is rapidly moving away from the saturated coast, shifting its focus toward the vast opportunities in the country's interior. This move into the Xingping market, county-level hubs and lower-tier cities, is now the primary growth vector. While coastal growth stabilizes, county-level markets are seeing a 54% year-over-year increase in orders. These markets represent a virgin landscape, with current penetration levels below 5%. Overhead in these areas is significantly lower. Warehouse rent in a county market is often one-third the cost of a Tier 1 city lease. Labor costs for picking and packing operations also decrease outside the major coastal hubs. These markets often lack the dense coverage of traditional convenience store chains. A single dark store with a 10-kilometer delivery radius can serve a wide area with almost no localized competition. Lower rent, cheaper labor, and less competition make the county-level market the foundation for the next phase of the 200 billion RMB expansion. The period of subsidized expansion is closing. Success in the dark store sector now requires operational refinement. As the network approaches 100,000 nodes by 2027, 3 analytical findings define the landscape. First, the consumer finding. Instant retail has moved from emergency shopping to a daily habit, specifically capturing the lucrative spending that occurs after traditional retail hours. Second, the consolidation finding. Overall growth masks the difficulty of maintaining a profit. Survival follows deep supply chain integration and digital inventory accuracy. Third, the geographic finding. Growth is moving inward. County-level markets, with their favorable rent-to-revenue ratios, are the definitive expansion engine for the next decade. 陶醉沙龙，马年兴隆。